Good afternoon, everybody. Uneducated Economist here. So we've had some pretty awesome days in the markets over the last few days here. In fact, I think it was one of the best days that the Dow has ever had was just the other day, followed by some really awesome days following it. So the market optimism is very high, but I think it's false optimism that's taking place right now. See, if you go and you look at the Wall Street cheat sheet, and if you've never heard of the Wall Street cheat sheet, I'll leave a link down in the description for it. And this is basically a graph of the market cycle, and it looks just like any other, stock market chart that you would ever look at, where it has a major peak and then followed by a crash in the price. And what it shows is the different levels of phases that take place during this market cycle. And it starts off with disbelief, where you have the initial run of the bull market that just starts off, and people are like, "Nah, I don't think so. I think we're still in a bad situation. These markets aren't going to go very high." And it's disbelief. They're saying, "No, that ain't going to work." Then it runs into hope, where people are like, "Wow." Because each one of these is a different peak. So you got disbelief, and then it crashes again. Well, it doesn't crash, it just drops down. Then it runs up above disbelief and it runs into hope, where people are looking at it going, well, maybe there is something to this market. Maybe we are going to start running. Then it goes into optimism, where people are like, geez, I really think this thing is going to work. They say, like, this rally is for real. And then it goes into belief, where they're like, for sure, yes, this is definitely a bull market. It's time to get in. Then it goes from belief to thrill, where they're like, man, look how much money we've made. This market is freaking killer. I'm just going to make all kinds of money in this thing. Then it runs all the way up to euphoria, where people are like, man, I'm the smartest person in the world. I've gotten myself stinking rich off the markets. This will never end. That's where it peaks out. That's what we have just experienced, was euphoria. Then it runs into the bear market, where things start turning downward. And the first level of that is complacency, where the markets sell off dramatically, but then you have a rally in the markets, and that's the complacency that people have, where they say, yep, anybody who didn't buy in just now, they're a fool. That was the bottom. We're going to be taking off again and hitting new all-time highs. Nope, don't fall for it. This is a false optimism. Then after complacency, it starts turning into anxiety, because after the complacency is over and we start dropping again, people are like, oh man, I'm starting to lose a lot of money again. I just bought into this market thinking that we were going to rally, but it's not rallying. We're actually dropping again. After anxiety, it goes into denial, saying, okay, you know what? That's it. We've hit the bottom. We're certainly not going to go any lower than this. Then it drops some more. And it falls into panic, where people start really getting scared. They're like, man, I'm going to lose everything I own if I don't sell out. After that, after panic, it goes into capitulation. Capitulation means that you have sold out. You're getting out. You're done with this market. You are not willing to lose a single dime more, and you sell everything you got. After it's all sold, you get angry. What happened to my retirement? What happened to all that money I made? Just a few years ago, I had hundreds of thousands, if not millions of dollars in the stock market, and now it is all gone. And you want to start blaming somebody. You want to blame the government for it. You want to blame the shorts, the people who shorted the market. You want to blame everybody you can, because you're in depression. And depression lasts for a while as you think, man, this market will never ever come back. Then it goes back into disbelief as the market starts to rally again. Now, this is the market cycle that takes place. And right now, we're at that complacency phase, where we just reached euphoria on the markets, and the markets dropped dramatically. People thought, oh man, this thing is crashing, but now we got this nice rally coming in. A lot of people refer to it as a dead cat bounce, where you have the markets peak, drop, and then all of a sudden they come up, look like they're going to do really well, and then they roll over again and they start dropping. Now, if you fall for the we're rallying again, think about what's going on in the economy. You just had the most layoffs, the most unemployment filings for unemployment insurance at any time in history. I think this was like the most ever. 3.2 million people have filed for unemployment insurance in 1 week. That is huge. That is like I said, I think it's what they said was like 4 times higher than the previous month, and like the most in history. Incredible. I mean, I knew it was going to be a lot of people, but dang, 3.2 million? That's insane. Then you also look at like things like mortgages. Mortgage rates are dropping. Typically when mortgage rates drop, people go off and file for a lot of mortgage applications. And the mortgage application filings are dropping as well. People are not interested in buying a house right now, even with the mortgage rates dropping. So what's happening there is that the Federal Reserve has stepped in and they said that they were going to do this, that they were going to buy a bunch of mortgage-backed securities, and that's exactly what they're doing. And when you start having a bunch of people who are looking over at the mortgage-backed securities, watching them drop, that gets them interested in buying those mortgage-backed securities as well. But it doesn't mean that you have a bunch of people who are taking advantage of those low interest rates. See, when you have a buyer for mortgage-backed securities, it's just like buying bonds. And if there's buyers for the bonds, that means that the price of them is going to increase, but the interest rate on them drops. As the price goes up, interest rates go down. It's pretty simple on how that works. But if you don't have the people who are actually buying the mortgages, applying for mortgages, then there is no market there. It's just the Federal Reserve buying up these mortgages, mortgage-backed securities. And they're also buying asset-backed securities. And those are like credit cards and auto loans. So you're seeing interest rates drop, but yet you're not seeing the sales. In fact, I think that they are projecting that there's going to be an 80% drop in auto sales. 80%. That's like nobody buying new cars. The only people who are buying new cars are people who are pretty confident that they are going to have the money to do it. Or crazy people, I guess. I don't know. But as far as I know, nobody I know is interested in going off and buying a new car right now. And everybody's real excited about the stimulus package. But the stimulus package hasn't passed yet. Okay, it's still in the works. So people are guessing that it's going to be signed, and I'm assuming that it's going to be signed, but it isn't in the works as of yet. It still needs to be signed by the president. So once that happens, then we can look at the stimulus package as probably, something that's actually going to occur, which it probably is, but it's not done yet. And these government bonds, think about this. There was a time when investors would buy government bonds. But government bonds are now turning negative. The 1 month, 3 month, those are in negative rates right now. And the 6 month is just inches away from going negative. So when you buy a negative rate bond, what you are saying is that I know for a fact that when I give my money over to buy this bond, that I am going to get back less money than what I've paid for it. Period. The only reason why somebody would do that is because they're speculating that the interest rates are going to continue to go down and they'll be able to sell that bond for a profit. That is speculation. That is not investing. Investing is when you're guaranteed a return. When somebody buys a piece of property as a rental property, that is an investment. You are anticipating that the person's going to be able to make their rent and that you'll be able to make money off that piece of property. But when you know for a fact that you're going to hand over money and anticipating that the interest rates are going to continue to go down, that is a speculation. And that's where we're at right now with these bonds. In fact, bond buyers, bond investors are not investing in bonds right now. Look at Ford Motor Company right now. Their S&P just downgraded Ford into junk. They are saying to Ford, you guys are not creditworthy. So you have unemployment reaching all-time highs. Well, I don't know about the actual number of unemployment, but the unemployment filings are reaching all-time highs. Or actually, I think the record highs. I don't know about new all-time highs at all. And you have bonds going negative and corporate bonds turning junk. You got all the reasonings in the world for a downward trend in the markets, but yet you're seeing them rally like crazy. That is definitely a complacency position. We are in a complacency phase in this market cycle, and just go and look at the Wall Street cheat sheet, and they'll show it to you. All right. I think I've had too much coffee this morning. Uneducated Economist, you guys let me know.